Sascha, thanks very much for joining us here. We heard 6 months ago in the Athens, we heard about what VIDA is doing, the product. But yeah, can you update us a little bit about what's happened since then?
Sure. Thanks for having us again. Been a great pleasure. In the last 6 months, we saw, I think, globally a bit of change in tone, how ESG is approached, how kind of institutions talk or don't talk about ESG, especially in the US. But what we see is still that there is kind of slight shift from using as just a reporting tool to a more strategic and kind of risk understanding profile. So understanding and optimizing complete portfolios, or even use it for due diligence purposes for larger or smaller kind of transactions to understand if it's worth to invest from a risk point of view, or if there's any insurance need.
I remember initially it was just about ticking a regulatory box, wasn't it? It was just a requirement that you have to make these kind of checks. But how does it develop there from that?
I mean, for a lot of people, it's still just a checkbox, unfortunately. But it's our way to get in, to kind of get a foot into the door, and then do a bit of educational kind of thing and teach and show people use cases, how they can use it in a strategic way, how they can use it in optimizing their portfolios and kind of do more with it than just once a year, tick the box, send it to the regulators and kind of do not touch it anymore.
You know, from policy point of view, yes, there have been changes. The Trump administration, in Brussels, the rollback of the corporate CSDD, whatever it's called, the directive reporting for that. Is it also the case for bank regulators when they look at risk and the kind of risks, the wildfire risks, which are becoming more apparent, the flooding risks? Are banking regulators still focusing on that as part of their risk analysis?
I think so. I mean, we're still waiting on the EBA report. I think there will be a few words regarding that. But so far, everyone we're talking to, we try to be in very close exchange with everyone kind of influencing these decisions, is aware of how important that is and how important kind of it will be in the future, because all these net zero and kind of climate initiatives are very important and are very kind of rightfully so. But most of the damage is already done, and we will just see that in the next couple of years and decades. And things like the Valencia flood here a few months earlier, unfortunately, they will just be more often and be more intense. And I think bankers, institutions and investors are more and more aware of that, because they just suffer from the losses.
Yeah. And big geographical differences. Obviously, some governments are more aligned with it than others. Do you see that different continents, different countries use your data differently for their reporting?
Oh, definitely.
In what ways?
I mean, the US unfortunately slowed down a lot because ESG is a word not many people use there, and sustainability and even risk is something they down-tuned a lot. The European market is still going strong. I think we are, in terms of ESG, in terms of sustainability, still spearheading the way for other markets. The Australian market is coming up big time for us, because they look a lot into what is Europe doing, how is kind of their taxonomy working out, and kind of using a lot of that. And a lot of Australian banks and institutes are using data providers and kind of consultants from Europe to just implement that. And so that is a market that is fastly approaching and kind of catching up to us.
Right. But no real changes with your product. It's still the same product across different jurisdictions. And
mostly, yeah. I mean, we are working on different things for a bit more short term, a bit more broader analytics, a bit more of the so what out of the data, because we saw that this is the biggest issue with a lot of institutes that says like, hey, the data's great, we want to understand that, but what now? So that's a bit where we're going to, giving them climate value at risk, kind of expected losses for different scenarios. That's where we're going, and that's what we already do to kind of enable these strategic decisions a bit better.
Right. And that concept of climate value at risk is a new one on me. Is that something which gets reported yet?
Not
or is it just
yet.
a matter of time?
I hope so. Like, fingers crossed that will be part of the future.
Should come from investor pressure, really.
It would be nice, yeah. No, so far it's really a more risk measurement
Yeah.
to give the risk departments and the controlling departments somewhat of a measure to kind of put a finger to it and say, like, hey, we are aware that there is a flooding risk, we are aware that there is a drought risk or something, but what the real outcome is for property X, Y, or Z was kind of hard to implement. So that's where we stepped in and kind of give these tools to them to say, it's like, hey, we have a 10% annual expected loss on that because it's a very high risk opportunity, and then they can translate that to a dollar or euro value.
And I guess if regulators aren't focused on it, and maybe investors aren't quite yet, the rating agencies are going to start taking climate risk more and more, or climate risk or other natural disaster risks more and more into their appraisal of collateral. Are you starting to get requests from them yet?
First talks, but as you probably know way better than I do, the industry itself is slow but steady.
Yep.
So I think next year, if we do another kind of the third round of interviews, I think can kind of maybe tell a bit more to that.
I look forward to that. It's going to be in Stavanger next April, so hope to see
Hopefully.
you there. Thanks so much
Thank
for
you.
joining us.
Thanks for having me.